Why do some business owners celebrate a successful sale, but later realize they kept far less money than expected? Many entrepreneurs spend years building valuable companies, but lack of tax planning can quietly reduce the wealth created from that success. The biggest mistake is believing the sale price is the same as the final amount received. Taxes, timing, and transaction decisions can completely change the outcome. Today, we will uncover 5 common tax mistakes business owners make before selling and explain how smart preparation can help protect more of their hard-earned money. Let's start with the number 1 tax mistake. Mistake 1. Waiting until the sale process begins before planning taxes. One of the most expensive mistakes business owners make is waiting too long to think about taxes. Many entrepreneurs spend years improving revenue, increasing profits, and building a strong company. But when they finally decide to sell, their attention goes directly toward finding buyers and negotiating the highest possible price. Taxes become an afterthought. This is a major problem because many tax strategies require time. A business owner cannot simply wait until the final weeks before closing and expect to find major tax savings. By that stage, many important decisions are already made. For example, the way a company is structured, how assets are managed, and how ownership is arranged can all affect the final tax outcome. A business owner who starts planning 1 or 2 years before selling has more options compared to someone who starts planning after receiving an offer. Early planning allows owners to review their company's structure, identify possible tax issues, organize financial records, and create a strategy that matches their goals. Another common problem is that owners focus only on the gross selling price. They think, my company is selling for $5 million, so I will receive $5 million. But the real question is, how much will remain after taxes and other obligations? The difference between these two numbers can be significant. Smart sellers understand that tax planning is not something to do at the end of the journey. It is part of building a successful exit strategy from the beginning. Working with qualified tax professionals early can help identify opportunities, avoid expensive mistakes, and create a smoother selling process. The earlier you prepare, the more control you have over the final outcome. Mistake 2. Ignoring how the deal structure changes tax outcomes. Many business owners believe that the only important decision is agreeing on the selling price. However, the structure of the deal can be just as important as the price itself. 2 transactions with the same purchase amount can create very different tax results depending on how they are structured. One common example is the difference between an asset sale and a stock or ownership sale. In an asset sale, the buyer purchases specific parts of the company, such as equipment, inventory, customer relationships, or intellectual property. Many buyers prefer this approach because it can reduce certain risks and provide tax advantages. However, for sellers, an asset sale may create additional tax responsibilities depending on the situation. Some assets may be taxed differently, and certain gains may not receive the same treatment as long-term capital gains. On the other hand, a stock sale involves transferring ownership of the company itself. This may create different tax consequences for the seller. The important lesson is that the same business can produce different financial results depending on the agreement structure. Many owners make the mistake of accepting a deal structure without understanding the tax impact. They focus on the amount written in the purchase agreement, but ignore what they will actually keep afterward. For example, a buyer may offer a slightly higher price through one structure, but after taxes, the seller may receive less money than another option. This is why sellers should analyze different scenarios before signing. A tax advisor can help compare possible structures and estimate the real after-tax outcome. The best deal is not always the one with the highest selling price. The best deal is the one that creates the highest value after all costs are considered. Mistake 3. Forgetting state and local tax effects. Another common mistake is focusing only on major taxes, while ignoring smaller tax obligations that can create a large impact. Many business owners think about federal taxes, but forget that state and local taxes may also affect their final proceeds. Depending on where the business operates or where the owner lives, additional tax responsibilities may apply. These costs can become especially important during a major financial event like selling a company. A business owner may calculate their expected taxes and believe they understand the final amount they will receive. Then, after completing the transaction, they discover additional obligations they did not prepare for. This creates unnecessary financial stress. Location can influence tax outcomes in several ways. The state where the business is registered, where assets are located, and where the owner maintains residency may all play a role. However, tax planning around location requires careful consideration. Moving or changing structures simply for tax reasons may create new complications if not planned properly. Another mistake is assuming that tax rules will remain the same forever. Tax laws can change, and business owners need updated advice before making major decisions. The solution is simple. Understand the complete tax picture before selling. A strong exit plan includes reviewing federal, state, and local tax responsibilities. Professional guidance helps owners avoid unexpected surprises and protect more of their sale proceeds. Successful entrepreneurs do not only build valuable companies, they also understand how to protect the wealth created from those companies. Mistake 4, not connecting tax planning with wealth transfer goals. Selling a business is not only a business decision. For many entrepreneurs, it is the largest financial event of their entire life. However, many owners focus only on completing the sale and forget to consider what happens after the money arrives. This is where wealth planning becomes important. A business sale can create a significant amount of personal wealth. Without proper planning, taxes can reduce the amount available for future goals such as family support, investments, retirement, or charitable giving. Some business owners wait until after the sale is complete before thinking about these issues. Unfortunately, many planning opportunities disappear once a transaction is finished. Before selling, owners should consider how the proceeds fit into their larger financial goals. Questions to consider include: how will this wealth be protected? How will it support family members? How should investments be structured? Are there legal ways to reduce future tax burdens? For some entrepreneurs, strategies involving estate planning, charitable structures, or wealth transfer arrangements may become important. The right approach depends on individual circumstances, but the key point is timing. Planning before the sale provides more flexibility. Planning after the sale often means working with fewer options. A successful business exit is not only about leaving the company, it is about creating long-term financial security from the value you built. Smart owners think beyond the transaction date and create a plan for the next chapter of their financial life. Mistake 5, failing to prepare for tax obligations after the sale. Many entrepreneurs believe the hardest part ends when the business sale closes. They celebrate completing the transaction and receiving their payment. But tax responsibilities may continue long after the deal is finished. One of the biggest mistakes is failing to prepare for future tax payments. A large business sale can create a significant tax obligation. If the seller has not planned properly, they may face a large payment at a time when they are already making new financial decisions. This can reduce flexibility and create unnecessary pressure. Some owners immediately invest their sale proceeds, purchase new assets, or increase personal spending without considering future tax requirements. A better approach is creating a clear plan before the sale happens. This includes estimating future tax obligations, setting aside appropriate funds, and understanding payment timelines. Another important factor is planning how the remaining proceeds will be used. Will the money be invested? Will it support retirement? Will it fund another business? Each decision can create different financial consequences. Successful entrepreneurs understand that receiving money and keeping money are two different challenges. The purpose of selling a business is not simply to complete a transaction. The purpose is to convert years of effort into lasting financial security. Proper planning after the sale helps protect the wealth created through years of hard work. Selling a business is one of the biggest financial decisions an entrepreneur will make. Avoiding tax mistakes requires early planning, professional guidance, and a clear understanding of how every decision affects your final wealth. The smartest owners do not wait until the deal begins. They prepare long before buyers arrive. Which tax mistake do you think surprises business owners the most? Share your thoughts below. If this video helped you, hit the like button, share it with other entrepreneurs, and subscribe for more business growth strategies.